Hi, this is Mary Corcoran, and this presentation is about the accounting process for the Accounting 101 students. The accounting process consists of a variety of steps and activities that we do as accountants that start with when transactions occur and ends when we consolidate all of the transactions into groupings called accounts and then produce our financial statements. So we go through a series of activities to turn our transactions into statements and then close everything out. So starting with transactions, a transaction is something that happens in a business that affects the financial status of the business. It can be something big or small, anything that changes the money. Even if somebody pays you a dime for something, you should technically record that as a transaction. I've seen some very, very big transactions. I put in my time at Costco corporate and saw, multi-million-dollar transactions. So a transaction might be big or small, but it's anything that changes the monies of the business. How do you know about transactions? Well, a lot of times you find out as an accountant because you receive source documents. Like, for example, shown here are receipts, invoices, deposit slips. And these would tell you the date of the transaction, the amount of the transaction, who is involved, the from and to people, customers or vendors, etc. So source documents show details of transactions. Sometimes you don't get all of your source documents. It's pretty typical in a small business. You're trying to figure out, oh, what did the owner do? The owner spent money out of his pocket to buy something, and forgot to keep the receipt. And so sometimes you deal with that. But for the most part, you should get source documents for your transactions. Once you have a transaction, you want to keep a record of it right away. In our class, we're just keeping track of a few small transactions in a very small, simple business, but you might think about how many pieces of software does Microsoft sell in a day, or how many items does Costco sell in a day, and how many transactions would that be? How many employees do they pay? How many vendors do they buy stuff from? So they've got literally millions of transactions in just one day. So it's exceedingly important to keep track of the transactions. Otherwise, at the end of the month, you have no idea what happened. And so journal entries are recorded on a general journal or a special journal. The general journal, you've seen in the textbook by now, is where you record every journal entry pretty much in sequential order. Sometimes you find out about them out of order, but you record them as soon as you know about them. Every transaction can be recorded on the general journal. Once in a while, you might want to use a special journal, like, for example, shown here is a sales journal. And the idea of a sales journal or any special journal is you might have a whole bunch of transactions that are similar, like, okay, debit, accounts payable, credit, cash. We've got a whole bunch of those. So instead of writing those all out on a general journal, we keep a sales journal, and we just record the transactions that have to do specifically with sales. Now, of course, in the real world, we don't record anything by hand. Really, it's very rare to find a business that does anything on paper anymore. Everything's computerized now, so the journals, all of them are kept by a computer. For example, if you go to Target and you buy something, and the cashier runs the item over the scanner, and you hear bleep, well, that's the computer recording the transaction. So once we've got all of our transactions recorded in our journals, we compile them into accounts in either T accounts or a general ledger. Both of these work similarly. There is always one T account per account. Only one account stuff goes on each T, and there's always one T for every account. Same thing with the ledger. There's always going to be a ledger section for each account. Shown here is the cash account, for example, of the general ledger. The difference is that the general ledger keeps a running balance of items, whereas the T account just keeps the debits or credits, and then you balance it out at the end. But you get to the same place in the end, which is that you want to find out for the accounting period, what is the balance of the account? Did it have more credits or debits? By how much? And so where did we end up for every account? Once we know what our account balances are, we move on to the trial balance worksheet, which summarizes all the balances by account. So debits and credits should balance, of course, just as always. And any adjustments needed are also calculated and recorded. So looking at the example here, you see in the first couple of columns, we've got our initial trial balance. The cash account is at a debit balance of $18,268. What this means is that when we calculated all the debits and all the credits, we found out what the footings were, and then we found out the difference, and we found out we were in a debit balance of $18,268. So you don't write down the total of debits and credits, you write the difference between the debits and the credits, with the total going to whichever one was higher. Same thing for equipment, office supplies. Now, you wouldn't be surprised to know that assets being a debit balance account, normal balance, all of these ended up with a debit balance. Like for example, I've seen cash in a credit balance. What does that mean? Somebody overdrew the account. So because you would want to have cash or your checking account in a debit balance, which means you took in more than you spent. So we just write all of these debit and credit grand totals for the accounting period on our first two columns of our trial balance worksheet. Then we have adjustments. We're going to go more into adjustments a little bit later in the term, but for right now, what we know is that some items are not actually transaction driven. They're actually calculated by the accountants. For example, depreciation. So we know that maybe we have a set of law library books in this example. They should last for 3 years, and we take the amount and split it over each accounting period for 3 years so it doesn't show up all at once. And we'll be talking more about that later, but that's what the adjustments are for. And then we get an adjusted trial balance. And with the adjusted trial balance, we simply add into the whole list of accounts our total with adjustments. From there, we can figure out our statements. What we do is we take everything that's a revenue and add it up into revenues on the income statement. Everything that's an expense gets added together and goes on the income statement. Revenues minus expense equals net income. From there, we prepare a statement of owner's equity. Sometimes this is a separate statement, and sometimes it's actually just part of the balance sheet. The whole equity section shows the owner's equity calculation. That's kind of common for big companies, actually. So, but the calculation's the same whether you do it separately or as part of the balance sheet, which is you look at what the beginning capital balance was, you add any investments the owner put in, you add or subtract net income depending on if it was a profit or a loss. You take out owner's withdrawals, in other words, the owner has paid him or herself, and then you get a capital ending balance that goes forward into the equity part of your balance sheet. Then you go back to your trial balance and you say, okay, what did I have for assets? Add all your asset accounts together, add all of your liability accounts together, do your calculation, and then we should know what the total equity is. So this is why it's important to have your chart of accounts handy, because you need to know what type of account every account is so that you know which statement it should end up going on. Finally, in the end, we need to close the accounts. What we do is we close revenues and expenses because we want to start the income statement over every accounting period. Because remember how we just moved the profit and loss over to the balance sheet? So we need to zero out the income statement and start over, so the next accounting period we can figure out profit or loss and move that over to the balance sheet. So we circle back to the general journal for closing. The income statements, accounts, revenues, and expenses are reset to zero for the next accounting period. What you see in this example right there is that we reversed everything. We did everything backwards. We have sales debiting. Well, that's to zero it out. And then we have a bunch of other type of accounts that we haven't talked about quite yet because we're not into merchandise accounting. But then in the end, what we do is we move all these to an account called income summary. And that's going to be a temporary equity account where we will use that as a vehicle to move everything onto the balance sheet. So then we adjust equity for profit or loss. The balance sheet accounts are carried forward to the next accounting period. That's why they call them balance sheet accounts, is because they keep their balances. Once we close the accounting period, we start all over again with recording transactions and going through the whole process. So we start with transactions, we do our journal entries, we combine these or summarize these into either T accounts or a general ledger. We create a trial balance based on our calculations from the T accounts or the general ledger. We move these balances, adjusted if needed, onto the statements according to what account types they are. Then we do closing entries to zero out the income statement again and start over. And the closing process also moves the income, the net income or the profit and loss over to equity.